Shares for beginners. Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
What your investment goal is and your investment time frame will ultimately lead you to what you should probably be investing in. If you've got a 1 year time frame, it is quite risky putting all your money in a high risk asset because there's not a bad chance that could be negative after a year.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What happened in ETF land in 2024 and what's coming in 2025? How do you build a portfolio of ETFs? Joining me today is Tom Wickenden. G'day, Tom.
G'day, Phil. How are you doing? Great to be on with
Good.
you.
Tom is an investment strategist at BetaShares and he's here to talk about the basics and building blocks in ETF land. Before we started, Tom, I just wanted to ask, as an investment strategist, what is it you do when you first arrive at the office in the morning? What's a day in the investment strategist look like?
Yeah, most mornings start with the news, right? I mean, our job is to work with financial advisors, to talk with people like yourselves, to help educate retail clients as well. And a lot of it revolves around what's going on in markets, right? We've got such a plethora of ETFs ourselves at BetaShares, but also in the Australian ETF landscape. And they really are, in a way, the macro trading tool, right? You can buy the Australian market or the US market. You can buy the cybersecurity industry, right? So there's big news going on overnight. We need to be across it because it's very likely that someone's going to ask that question. So get in, read the morning updates from the plethora of researchers I read, see if there's anything that we need to do immediately. Then we get into, talking to people like yourself and the likes.
So this morning, what was it like this morning? We were recording on January 28th and there was the rout in Nvidia overnight on Wall Street. Then there was the bounce back overnight as well, and all to do with DeepSeek. What's your response to news like that?
Yeah, it's been a busy few days. We're currently putting together our outlook for 2025. We like to do it on this end of the new year because if you wrote it a month ago, it's probably already mute. And we head out on the road next week to do a big roadshow around the country, speaking to financial advisors. So I was in the midst of putting that outlook out and doing some slides, and then obviously the news dropped. Mainstream news dropped yesterday about DeepSeek, and that threw things into chaos, really. We had a lot of PR, speaking to a lot of the journos about it, putting more publications out, and then also just trying to adjust our views, thinking, okay, how does this affect the current market narrative? Is this a serious threat to US exceptionalism? What does it mean for the AI narrative, which is so central to investing at the moment? And so all of those factors come into play, and we have to really change quite quickly as to what we're speaking about and how we're speaking about markets.
So I guess you've gone long Trump coin as well over the last week or so.
That was a lot of talk. We got back from holidays, and then there's Trump coin that made Trump more money than all of his developments did within a few days. And it's been, how do you even factor that in, right? You've got an incoming US president who's then listed his own meme coin that theoretically could be used for a lot of different purposes. People trying to give him money for certain not great purposes. Could be people punting on it and losing a lot of money because they don't really understand what's going on. Or people thinking, this could be so meddled with, given he's the incoming US president, that surely it's going to the moon. But Phil, I do just want to make it clear that we don't really promote those meme coins. They are speculative. They're tools for gambling, and we focus more on the real investment side of companies and ETFs and businesses, right? So.
Okay, well, let's get back to sensible investing. What happened in ETF world in 2024?
Yeah, 24 was another amazing year for ETFs, both globally and here in Australia. Globally, the numbers are quite astonishing now. We saw about 1.5 trillion US dollars inflow into ETFs globally last year, right? So it's quite amazing, the numbers we've gotten up to. Within Australia, it was also a record year. So the market, or the ETF industry, ended around about 250 billion Australian dollars was what the FUM got up to. It was a really strong year for net flows. We typically look at net flows. So the overall increase in assets under management is going to be impacted by two things, right? There's new money coming in and there's market movements. So last year was obviously quite a good year for market movements. That really helped the assets under management. But looking at actual net flows, how many more people are buying into the Australian ETF industry, we saw about 30 billion Australian dollars of net inflows last year, so net buys and sells, which was double what we saw in 2023. So a really strong year, a record year for the Australian market. Within the Australian landscape, the flows are still fairly concentrated. So there's three big players in the Australian market, being Vanguard, BetaShares, ourselves, and iShares. Between those three names, we brought in 80% of all the inflows all the net flows into the Australian ETF market. So, and all those names investors might be acutely aware are traditionally more passive investing names. So it's fair to say a lot of the flows still going to the larger passive players. Despite quite a large surge in active ETFs listing in the Australian market, a lot of active funds are listing as ETFs because it's such a popular way for people to invest these days. We actually saw $1 billion of net outflows from active ETFs last year in the Australian industry. So they're actually a detractor from that $30 billion figure.
So what do you think the overall awareness is like for ETFs? I mean, there's a lot of people who still don't know what they're aware of, but do you think the awareness is increasing as time goes on?
I think definitely. I think so. I mean, it's the fastest growing investment vehicle globally and here in Australia. It's fair to say when I started at BetaShares about 5 years ago now. And at that time, I would still speak to quite a few advisors and brokers who didn't understand the basic fundamentals of ETFs, didn't understand how they traded. They were confused about things like listed investment companies and ETFs and the differences there. And, fast forward to today, that's a very rare conversation, ETF 101. Now it's really about what's available and what are they doing. I think that's also translated in the retail space as well, the direct consumers who buy ETFs via their platforms themselves without advice.
Yeah, ordinary punters.
Exactly right, the average punter. I think particularly after 2020, we saw the significant market crash following COVID in 2020, and then quite an amazing market rebound. And that year, 2020 and 2021, we saw really large participation from the average punter within ETFs. It slowed down a bit in 2022 when things got a bit hairy again in markets. We saw a bit of a sell-off due to interest rates rising, but it's fair to say the awareness has grown for that period. And yeah, most of the conversations we have now with the average punter or the financial advisor is what's available in your ETFs instead of what is your ETF,
Do you think people are becoming more aware as well I mean, you know what an ETF is, but the fact that your super or investments via a financial advisor, the overall costs can be reduced by using ETFs rather than managed funds, which tend to cost a bit more.
Yeah, exactly right. It's all part of why ETFs have grown so large. At their most basic, an ETF is just an investment vehicle, right? It's an investment vehicle that is very efficient for holding listed assets. Okay, so historically, before the ETF, if you wanted to, invest in listed assets, you'd have to go through a managed fund or unlisted fund. It's almost like an ETF is a new piece of technology, and it just so happens to be really efficient for listed assets. And it was also synonymous to the growth of ETFs with passive index investing, right? Just it so happened there were index funds before the ETF, but it so happened the popularity of ETFs and index investing kind of coincided, and they became synonymous with each other because the ETF was a perfect way to access an index. Index investing was synonymous with the growth of ETFs. And part of the reason is, an ETF is such a great way to access an index fund. And it comes down to, as you were mentioning, Phil, some of these, efficiencies of ETFs. So you mentioned that they typically are low cost, particularly if you're looking at an index fund. There's no active management going on. You're not paying rockstar stock pickers to try and outperform the market. You're really just buying the market, which is a bit easier for a portfolio manager to put together and make sure it's rebalanced well. Ease of access is another great advantage or efficiency, if you will, because you can just buy them on the share market, on the ASX, like you'd buy a stock, which most people are intuitive with. And then finally, another huge one is just diversification. This has come along with more investor education, but people know being diversified is a great way to reduce volatility, to reduce some risk in portfolios. And ETFs just bundle up a lot of those great advantages in one simple place.
So what are you looking forward to in 2025?
I think within the ETF industry, looking forward to more adoption. I think it will come, but I guess the product development's what's really exciting me at the moment. As I just mentioned, the initial growth of ETFs came in those more broad market index funds, your ASX 200s, your NASDAQ 100s. Everyone's pretty aware of those now. Those are great, low cost, etc. But where we're seeing ETFs going is almost into a new iteration of funds. And we saw this for the first time last year. So in the flows last year, 21% of the flows in the Aussie ETF market went into what's called a smart beta ETF. And this is just one type of product development that's going on. But a smart beta ETF, essentially, rather than just holding the broader market, it looks to hold companies that align to certain risk factors in the market. So what I mean by that are pretty common ones like a quality ETF, right? Instead of holding the MSCI World, which is like every company in the world by market cap, we say, you know what, I only want to hold the top 150 companies that have good earnings, have sustained those earnings over a period of time and have low debt to equity. Now, that's more sophisticated than your basic index fund, right? But you can still do that in a pretty cheap manner. It's still like, fairly systematic, and you're not going as far as stock picking or going down that path where you need to pay someone to do the stock picking. So that category of ETF really excites me. Smart beta ETFs. It's not just quality. There's growth, there's value, there's income. So they're really exciting. But it's just one example of the new solutions that are coming out within the ETF wrapper. ETFs for fixed income, which is growing in popularity. ETFs or diversified ETFs even. ETFs of ETFs, but gives you, access to like 7,000 underlying equities with a single purchase. Really awesome for ETF beginners, for young accumulators, and for growing that diversified portfolio.
So how would you suggest newcomers approach the ETF market? Because you've just come through with some pretty sophisticated kind of investments, ETFs of ETFs and smart beta and that top 100 companies, 150 companies. Is that in the world or the ASX 200?
So we've got one global quality leaders, and it's in the world. We've also got an Australian one too, actually, our Australian quality leaders. Similar idea, but just in the Australian market. Yeah.
Are you confused about how to invest? LifeSherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. LifeSherpa, Australia's most affordable online financial advice.
Yeah, okay. So a newcomer's approaching the market. I mean, would you suggest going straight into a basic index-hugging ETF to start with and learn about it, or what's the best approach?
Yeah, really important question, right? So actually, it's one I get to answer this a lot because a lot of my friends who work in different industries go, "Oh, you work in in ETFs. Can you give me some general advice as to how I?"
Yeah. What share should I buy?
Yeah,
Exactly. What should I pick? What lithium should I be in?
Yeah,
what lithium miner should I be in?
And I'll give you the exact same answer I give them. I say, what is your investment goal? Why are you investing? Are you investing to take an absolute punt on Trump coin? Probably not. Most of my friends aren't. Most people are investing, as a young accumulator, either just as like to have this money aside in the market for the very long term for retirement. Some people will say, in 7 to 10 years, I want to try and put a deposit down for a house. And some friends say, look, in 1 to 2 years, I want to, use that money for, a big holiday. And that has to be the starting point for all investors, because what your investment goal is, and your investment time frame will ultimately lead you to what you should probably be investing in. If you've got a 1 year time frame, it is quite risky putting all your money in a high risk asset, because there's not a bad chance that could be negative after a year. Most people I speak to, I think most people who listen to education podcasts like this typically have a longer term time horizon. They're typically looking for long-term growth. That's a bit of an easier conversation. You say, okay, say you've got a 10 plus year time horizon. You probably can take on a bit more risk, though. Everyone's different. Everyone's risk tolerance is a bit different. But if you're investing for the long term, you can typically take on a bit more risk. So then you start a conversation around, ETFs offer you access to growth assets, both here in Australia and internationally, as well as defensive assets like fixed income. So what split are you looking for? Do you want to go 100% in growth in Australian and US equities and, invest for long term and hope that those equity markets provide, good wealth creation for the long term? Another important thing, when we think about investing is the investment plan I speak to them about. It's not just about, okay, I've got $10,000 today, put that in, leave that for forever. What's much, much more common is we're getting an income, right? We've got money coming into our bank account each month. We want to put that to work. And this is actually de-risks using a strategy like what I'm about to mention, like dollar cost averaging, right? Because dollar cost averaging is, say I get my salary each month and I put 20% of it in a select, ETFs. If I do that every month, I'm kind of buying in slowly over time. So it kind of de-risks that initial entry point. If I could invest today and the market could crash tomorrow, that's okay. It's my first parcel. I'll invest again the next time. And then to come to your original question, what actual ETFs would I advise? Look, for most of my friends or most people who are starting out, I say keep it pretty simple. Keep it pretty simple in those, low cost, broad market, well-diversified ETFs. And over the long term, history would say you can't do too wrong. Someone like myself, I, because of my role, try and get a bit more nuanced and a bit trickier with things. And I might use those, quality ETFs or smart beta ETFs. But I guess I understand those avenues a bit better. And as investors go along their investment journey, once they've invested in broad market ETFs for a while and understand what that feels like, they can do some more research and maybe they'll get comfortable with more smart beta ETFs or more technical things as they go. But the key is just getting started. Once you get started, you learn so much from that process.
So, Tom, you referred to risk. Now, in finance land, that's interchangeable with volatility, isn't it? The up and down movements. Yeah, because I think a lot of people don't actually understand risk. They think of, the risk of losing your money like when you're punting on a horse, when in fact, it's to do with volatility. And you referred to dollar cost averaging as well, because that takes advantage of the volatility because you're buying expensively sometimes and you're buying cheaply at other times. Just explain a little bit about the concept of risk versus volatility, or are they the same, two sides of the same coin?
Yeah, exactly right. Like a lot of the times when you hear risk in finance, as you have alluded to, we are talking about volatility. And what volatility is in layman's terms is, how much is the price of your asset going up and down? Because if you think about it, if we start at point A and we've got two different assets, we've got asset X and Y. If we start at point A and go forward 1 year, let's say they both end up returning 5%. Okay, great. They've done 5%. But one of them just went up a nice long straight line. You sat there, trickled up each day in your portfolio. Lovely. That's great. The other one, it still returned 5% in the end, but over that year it went up and down 20% each month. Now, the one going up and down 20% is more volatile, more risky. And, investors might hear terms like risk-adjusted returns. It's something people look at because if you can have an asset that goes, that returns the same amount but for much less volatility, it's more appealing to the average investor. You don't want to see your investment go up and down because you know what? A lot of investor biases say you might actually sell that thing when it's gone down 20%. You might, not stick to your original investing plan. So that's why we consider risk quite a bit in the finance landscape. And what's really good about a lot of diversified ETFs, or those broad market ETFs, is because you're holding a basket of stocks, it can de-risk or take away some of that volatility. So another example, you've got a single cybersecurity stock versus a basket of 30 cybersecurity stocks. Now, that single stock, it could shoot the lights out. It could have some idiosyncratic risk with the company and have a big falling out and drop a lot. And so that's going to be a bit more risky than holding 30 cybersecurity companies that, you're kind of getting exposure to the cybersecurity industry. But since you got weighting in each of them, you're taking on less single stock risk or single or idiosyncratic risk. So you would expect that basket of companies typically to be less volatile than the individual one. And that's a great advantage of most ETFs. They tend to be fairly well diversified within their region or sector or thematic, which can be really good for all types of ETF users, but particularly beginners.
Yeah, avoid single stock shock.
Yeah, exactly right.
Yeah, we've all seen that. So, okay, buying ETFs is only the first part of it. How should investors think about the relative weighting? How much of each kind of ETF should be in their portfolio? And again, it's, there's so many different answers to this question, but just take us through a couple of simpler kind of examples.
Yeah, I think probably the easiest way is just through a simple example, starting at the top though, So it's some of the concepts we've already touched on. Before we even get to the individual ETFs, we start with asset allocation, right? And what I mean by asset allocation is how much of our portfolio we're putting in growth assets versus defensive assets at its most simple. We already kind of discussed this a bit, but let's think about a young accumulator, right? A young investor who's investing for the next 20 years, very long term, probably going to have a higher skew towards the growth asset side of things, which are typically things like equities. We think about equities as growth assets. If you think about an older investor, like a retiree who's got a large sum of money, wants to maintain that but get income from it, you'd be sitting more in the defensive camp, right? So that's the first way we have to think about splitting. Now, if we move a level down below that, sticking with the young accumulator, within the equities, now we're Australian investors. I assume a lot of the listeners are Australian investors too. There's a great Australian stock market we can invest in. There's also the international stock markets. There's the US stock market, European stock markets, etc. So the next decision is, okay, within our equities, how much Australian and how much international do we want to hold, right? And I guess to dig into that a tiny bit, each stock market is kind of different. At the Aussie market in Australia, we've got some large mature banks and resource companies, which are older companies, really good for income historically, but less growthy. If you look at the US market over in the United States, their market's concentrating these big technology giants like Amazon and Alphabet, which is Google's parent company, right? So they're more tech and more growth orientated. So you have to sit down and consider that and say, okay, well, do I want more growth like from the US or more income from Australia? And look, most Australians, I think, from some research I've seen, typically sit in about 40% Aussie, 50% Aussie, and 50% global. There's no right or wrong answer there, to be honest. Now, once we've got down to that level, then we can think about the individual ETFs. So we've said we want to put 40% in our Aussie investments, right? Then we can go to the Aussie ETF landscape and say, well, there's probably over 100 ETFs in Australia that focus on Australian equities. And so this comes down to how granular an investor wants to get. As I mentioned earlier, you can keep it simple. Like we've got an Australia 200 ETF, the ticker code's A200. That's 4 basis points, right? So $4 for every 10,000 invested. Super cheap. It's diversified across the top 200 companies in Australia. That just gives you access to our market. Really simple. And you could stop there. There are actually other ETFs from other providers that also do a similar thing, like a Vanguard Australia 300 fund or an iShares one. In that land, you really just want to look at if it's a similar thing, if it's a commoditized good, a commoditized product, you really want to look at have they performed the way they should and what's the price of them, right? So, for instance, in that landscape, we've got the lowest costs. We think that's a good advantage for investors. But then we could also compare outside of the broad market index. So an investor could start to look at some of those smart beta ETFs I talked about earlier. There's quality ETFs in Australia or value ETFs. When you're comparing those types of ETFs that are a bit more nuanced, you just want to look under the hood, look at things like the management fee. How much is it costing? Is that similar to, other similar ETFs that are available? What are the holdings? The holdings look like do they look like growth holdings? If you know, or maybe the sectors might be easier. Is it holding a bit of technology, which tends to be growthy? So is it doing what it says on the box, or does it look like it's doing what it says on the box? So once you've decided how much to allocate to the Australian equities portion, then we can get to the ETF level fill. Sorry, it took a while to get there, but that's
okay. It's great to listen. I want people just to have the words wash over them because they mightn't understand every word to start with.
Exactly
but,
right.
You've just got to listen to the words, and things will become clearer after a while.
It's really important for framing. So that's when we can start comparing individual ETFs within the Australian market, because that's where we've got into, right? There's a whole plethora of different ETFs. We can start again with those more simple ones. For example, we've got a Australia 200 ETF. Ticker code's A200. That's super simple. That holds the top 200 companies listed on the ASX, weighted by their size, right? And you can get that for 4 basis points, which is really cheap. And that's that first iteration of ETF that's really cheap, well diversified, great diversified access. And so that's awesome for the average investor or the starting out investor. But then within the Australian landscape, there's also different types of ETFs. So there's ETFs that really hone in on income, for instance. There are strategies that hold companies that tend to pay higher dividends. So maybe as an investor, you want to get more income out of your Australian equities part of your portfolio. You can look towards those type of ETFs. Or again, thinking about those smart beta funds I talked about earlier, maybe you want to try and extract a bit more growth out of the Australian market. I mentioned that it tends to be a more mature market, so a little bit lower growth. But there are some ETFs in Australia that focus on growth to, address that issue, like a Australian quality ETF that I mentioned earlier. Now, when you're comparing, ETFs, you want to look under the hood. So you want to look at what type of fees they're charging. For a passive ETF, typically ranges from 40 basis points and right down to the 4 basis points I mentioned earlier. On the fund page, this is such a great tool. Can't stress it enough. Each ETF in Australia will have its own web page, its own fund page. We've got a big website and every fund has one. And there's a description there. It says, is this growth or income? It shows you the top holdings, the sectors, the geography. Really awesome tool for analyzing an individual ETF or comparing to ETFs. So that's really, really good way to start for investors.
Yeah, I always tell people as well to have a look at their super fund because you're going to start learning about asset allocation, weightings, like a conservative balanced fund is going to have weightings of different kind of asset classes. And it gives you just a little bit more knowledge and tools, I feel, to be able to approach an ETF portfolio or a share portfolio as well that you might be trying to construct yourself.
Yeah, it's such a great example. Like, if you're coming from a point of not having any idea about how to allocate towards the US or Australia or growth or defensive, exactly. You can look to what your super fund's doing, what's their balance, what's their high growth. Even a good example is those diversified ETFs I mentioned, right? Though within the diversified ETFs we run, we set an asset allocation in there. So you can go and look at our ones and go, oh, okay, so their growth ETF has, 70% in equities, 30% in defensive. That, gives me a bit of an idea around how professional managers are managing their money.
When should investors consider dividend reinvestment plans rather than taking the dividend themselves every quarter or month?
Yeah, good question. So maybe for those that aren't aware of what that is, essentially, within an ETF or even an individual share, you can often, set it up so when a dividend's paid or a distribution's paid, instead of that going to your bank account, it actually buys more units of the same ETF or buys more shares of the company. This can be a really handy tool. And again, it comes down to, why have you invested in that ETF, right? If you'd invested in it for income, okay, chances are you're probably going to want, to take the income as normal from the distribution and just use that for whatever you saw fit. But some investors, they're investing for the long term for growth, and the ETF might spit out a 1, 2, 3% dividend. And instead of that hitting your bank account and heading out on the weekend and spending it, you can really accelerate your capital growth by opting in for that DRP, putting the money straight back into the investment, pretending it, don't let it hit your bank account, put it straight back in. This can be a really powerful tool for long-term wealth creation, because you're not only is your capital growing if the investment's growing, not only hopefully are you maybe contributing each month to it, but you're also having income flow back into it. So all these different sources of growth are really, really powerful over the long term. They compound over the long term to generate really strong growth.
Yeah, and they're otherwise known as drips, aren't they?
Exactly
That's
right.
another one, a bit of a jargon there. But yeah, it's just worthwhile thinking about, say, the basic ASX 200 for the last 10 or 15 years. There hasn't actually been that much growth, but a lot of the income has helped the value of, a dollar invested in, say, 2006 to what a dollar's worth these days. Am I saying that correctly?
Yeah, that's exactly right. If you had invested in the Australian market, can't remember exactly. I think it was we did this recently for...
yeah, that's right. I think it was only the peak before the financial crisis was around 7,000, I think, for the ASX 200 or something, which it's only just been beaten in the last year or so.
Exactly right. So if you had invested in the Australian market and not had that DRP on, for instance, sure, you would have returned a decent amount of income, but your capital would be flat, which is quite remarkable to a lot of people. The other great thing, let's say you're getting towards that stage where maybe you want to start taking some income out of the market. By using the DRP, you're actually growing your capital base higher and higher, so that when you want the income, there'll be a higher income base coming out anyway. So it's a great way to grow that capital base until you've got enough in there to say, you know what, that's good in there, and I can get some pretty good income out of this. And what's cool as well, Phil? You don't have to do 100% DRP. You can do 50% DRP. So, leave half the money in, take half the money out. And so maybe as you're going on your investment journey, as you're getting towards a retirement phase, you can start with 100% DRP when you're younger to grow your capital. And as you get later on, turn it lower and lower and take more of the income out as you need it.
So what's concentration risk? That's something we hear about in ETF land, and you just basically want to make sure that you're as diversified as you really think you are.
Yeah, exactly right. I think there's probably two things to consider here. The first one is concentration risk, even within a single ETF. It is possible, to have an ETF that's tracking a market, and that market might become concentrated. There's a lot of talk at the moment about how big the US tech companies have become. If we look to the S&P 500, for instance, which is a broad market index, you've got about 25% of the weight of that index in 5 names. So that's one concept of concentration, which we manage in various different ways. For instance, I may as well mention we've got an S&P 500 equal weight ETF. So rather than that traditional, market cap weighting where the bigger you are, the more weight you get, you just give each 500 companies the exact same weight. So that's one way of, diversifying single ETFs. But I think your question also alludes to, if you're holding multiple ETFs, you have to make sure you understand what's under the hood, because, you could hold, 3 ETFs that essentially hold the same thing. And so it's just as good as the one, right? And the best way to solve this is to know what you're investing in. So, if you're holding a MSCI World Index, which invests in lots of companies around the world, and then the S&P 500, which I just mentioned, you're going to have decent overlap at the top end and some big US tech companies. Maybe you're completely comfortable with that. Maybe that's what you're investing in those for. But just understanding that, and then understanding, okay, I could buy the Australian market instead, because you know what? The Australian market only has a 2% representation in the MSCI World. So there's not much overlap there. And that's a great way of diversifying amongst ETFs. But yeah, super important. And it comes back to looking under the hood Having a look on the website and just looking at those even the top 10 names will give you a good indication of your overlap with other ETFs.
And I'll just point out the share site look-through tool, which is a great way of looking at ETFs as well. What's a geared fund? Because I believe how many geared funds have you got now?
I think we've got 5 geared funds now, or 5 positively geared funds.
Yeah, so what does that mean? And are they suitable for all investors?
Yeah, good question. Good question. So, I mean, a lot of Australian investors will already be familiar with the concept of gearing through the property market, right? We know, generations built a lot of wealth in the property market, and a lot of that was due not only to the price appreciation of property, but actually due to people gearing into the property market by taking out a mortgage, right? So
only putting 20% down, but
exactly right.
getting advantage of the capital gain over the whole of the property.
Exactly. It's like a super simple example for investors who are still scratching their heads. Let's say I had $5 and I borrowed $5. Okay, so I invest $10 into the stock market and it goes up by 10%, right? So it's gone up by $1. Now that $1 goes to me. I've still only borrowed $5. Now I've got $6 of my money. So the market's gone up 10%. My return's 20%. I've doubled my return, right? Now, a fairly recent iteration of ETFs has been some funds we launched last year, some moderately geared ETFs. And it's just a really simple way for investors to get access to gearing or borrowing into the stock market. Historically, investors could do this through things like margin loans, but they're typically pretty expensive and it's quite an onerous process. Like now you can just buy a single ETF in the ASX the same way you buy BHP or A200, and underneath the hood, internally we're borrowing money, we're gearing the portfolio, we're rebalancing to make sure it's in the right range. So a really awesome tool. So they're not for every investor. No, it's hard to say that any single ETF is for every investor, but these ones...
Is their price reflected in the volatility reflected in their price?
Yeah, exactly right.
So they can go down a lot more than just an ungeared fund.
Yeah, exactly right. So it sounds all good and well. That example there market goes up by 10%, but market goes down by 10%, you lose double that in that previous example, right? So you have to be careful. As we talked about earlier, there's higher risk or higher volatility within these types of ETFs. Where they probably can be good use cases, that young accumulator investing for the very long term. So time can usually hedge out some of your risk. Also for people who, understand them well and are using them, as a portion of their portfolio to maybe put less capital in to get the same amount of the equity market within a diversified portfolio. But even a good use case we've seen a few times is, quite wealthy investors, people who hit that $3 million superannuation cap, and they can use a geared ETF to get even more than that, 3 million they're meant to. So there's a few interesting use cases. We've got really good resources on our website, actually. If you look up, BetaShares Wealth Builder Funds, we did a brochure, talking about just, gearing into stocks in general, not specifically our funds. We get to that point, but it's awesome education tool for investors who think that could be of interest to them or of use to them. Definitely do your research first, as you said, but potentially high return, but that always comes with high risk.
Can you buy those geared funds in an SMSF? Because I think there's very limited ways of leveraging into the share market if you're running an SMSF.
Yeah. So, all of our ETFs are listed on the ASX, right? So if you're SMSF, which I think all do, have access to securities in the ASX, you can buy those ETFs, and it gives you a great way of accessing, a moderate level of gearing within an SMSF. Even within some non-SMSFs, there are some superannuation platforms for those who are not at the SMSF stage just yet that allow you to pick your ETFs. Actually, there's some out there in Australia. And even those you can use some geared funds as well. So there's a few ways you can use them in superannuation.
So you mentioned moderately geared. What does that mean? I mean, say compared to, say, a property that you own, which is 20% your own money and 80% the bank's. Is that highly geared? And how does that compare to a moderately geared share portfolio in an ETF?
Yeah, really good question, actually. So historically, I'll take us back a little bit. And I'll take us to the US firstly. In the US, they've got a lot of leveraged ETFs. A lot of their leveraged ETFs, 3 times leverage. So you're getting 3 times the return and 3 times the volatility of the underlying. In Australia, there have been some leveraged ETFs available for quite some time. And those were around 2.5 to 2.75 times leverage. So those we'd classify as probably, more highly geared. 2 to 2.75 times your returns is quite a lot more risk being taken on. when I talk about moderately geared, these are some funds we put out last year that are down to, they're around the 1.3 to 1.7 times range. So there's just a lower level of borrowing going on, which is going to give you a lower level of volatility, which is typically more stomachable for the average investor or for most investors. That it's easy to stomach that level of volatility. And we think it's a good level for, the average.
It's a sweet spot, is it?
Somewhat. It's just lower than what was available before. And because before, the leverage ETFs in the US and those high leverage ones, that have typically been used as trading tools, right? That, short term, trying to pick the market, which is not what we want to do with long-term investing. We want to be able to hold something over a long time horizon and grow from it. And these work much more like they should for a long-term investor, is probably the best way to put it. Yeah.
So tell us about buying ETFs directly from BetaShares. You don't actually have to go to the market, do you?
No, not anymore. So a really exciting development over the past few years here at BetaShares is we have launched our own platform for investing. It's called BetaShares Direct. So again, people can find out a lot about it online, but essentially just like, other investment platforms, you can go onto BetaShares Direct. You can buy any Australian ETF, which is great. Not just BetaShares ETFs. You can buy our competitors' ETFs as well. And we've also got access on there now to, the 300 largest companies or 300 of the largest companies shares on the ASX. So that's really awesome. So investors can go there. One of the great features, Phil, is that it's zero brokerage. So, we talked about dollar cost averaging earlier and how it can be really good to buy a little parcel each month. One hindrance to all investing is fees and costs, right? ETFs are great because they're typically low cost. That's a first tick for long-term investors. One issue can be, though, depending on, the investment platform, you can pay $5, $10, $15, $20 each time you go to buy and sell your shares or ETFs. So what's really awesome and what we're trying to do with BetaShares Direct, just like we've done with ETFs, is to make investing frictionless. And you can now access the low-cost ETFs for free, which is really, really awesome through BetaShares Direct.
Are they recorded on a holder identification number, like if you're in the CHESS system, or is it a different kind of ownership structure?
No, so it's the omnibus structure. Obviously, that was a pretty, important consideration. A lot of the legacy investment platforms were using the HIN structure. That means they've got their own holder identification number. However, it's becoming more and more common to use an omnibus structure, which means it's just held under a single HIN. Obviously, the assets are still under the same regulations. They're still safeguarded with a custodian, but it allows us to do some really awesome things like fraction investing. You can buy a fraction of an ETF or a fraction of a share. We've got features like auto invest, which allow money to come out of your bank account straight into the investments in the ETFs. We've got managed portfolios. You can build your own set of portfolios. And a lot of these things are made a lot easier and a lot more efficient using that omnibus structure. So we went down that route because we thought it was the most frictionless way for investors to get access to the market.
And so apart from that, the management fees are still only the fees that are embedded in the ETFs themselves. Is that how it works?
That is correct. So if you just go on and you're just using it very simply to buy and sell different ETFs and shares, it is. If you want to use some of those extra features that I mentioned, like I personally use the model portfolio, I build my own little portfolio and say I want 10% in this fund, 20 in that fund, 20 in that fund, 10 in that, so on and so forth. I set that, and then when I put money in, it automatically rebalances for me into those funds. They charge, there's a small fee for that feature, or there's a small fee for the auto invest feature, but you can use the platform at its most basic to buy and sell ETFs, as you're probably doing on other investment platforms at the moment, for completely free, for zero brokerage.
So if listeners want to find out more, where can they go?
For everything we've talked about, the BetaShares website. A lot of the concepts we talked about earlier on about asset allocation, about investing in Australia versus the US, about what's interesting at the moment. We've got insights pages and education courses on our website. For the individual funds, under the hood, as I mentioned, fund pages with the fees, description, what it's holding, and then BetaShares Direct as well. Awesome information and videos and everything on the website there to give investors all the information they need.
And as a proud Aussie, it's great that BetaShares is number 2 amongst all the global giants that run ETFs in the world?
Yeah, that's
here in Australia. Here in Australia, yeah.
Yeah, exactly right. We're pretty proud of that fact. Like, I'm pretty sure it's true that if I look to all developed markets in the world, if you look at their ETF industry, the 1 and 2 is Vanguard and BlackRock, or Vanguard and iShares. Everywhere in the world except here down under in Australia. We're very proudly Australian. We've, in our growth, we've listened and we've understood, the Australian investor, I think, better than our competitors. And it's led us to now, being number 2 in the Australian ETF industry for funds under management, just behind Vanguard, but we're chasing them down. Don't worry, Phil.
Tom Wickenden, thank you very much for joining me today.
Thanks, Phil. It was a pleasure.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.